Did you know there's a way to invest in Canada without paying any taxes on your gains? Imagine growing your money without the government taking a chunk every time you make a profit. That's the magic of the tax-free savings account. This account was introduced by the Canadian government in 2009, and most people don't really understand how this account works, or in most cases, it's usually underutilized. But if used correctly, can be a game changer for anyone serious about growing their wealth here in Canada. In today's video, I would uncover the hidden perks of the TFSA, why it is more than just a savings account, and how you can maximize your returns. So whether you are a seasoned investor or someone who's just starting off, this video will show you why the TFSA should be at the top of your financial strategy. When you invest in a regular investment account, you're putting your money in there with the goal of growing it over time. However, when you eventually withdraw some of the monies that you have invested, you must sell off your investment and pay taxes on the profit. To encourage people to invest more without the worry of a heavy tax burden, the Canadian government has introduced several types of tax-advantaged investment accounts. Each of these accounts offer different tax benefits. But today, we're focusing on the TFSA, the tax-free savings account. Now, the name tax-free savings account can be a bit misleading, all right? So let's clear that up a little bit right now. It's more accurate to think of it as a tax-free investment account rather than just a savings account. While you can use it purely for savings, you won't be able to take the full advantage of its benefits if you use it for savings alone. The primary benefits to know right away is a tax-free status. Any investment within this account are shielded from taxes, okay? Meaning that if your investments grow and you make money, you won't pay taxes on those gains. This is the key reason why you should be using the TFSA primarily for investing rather than just savings. And to break it down a little bit more, let's say that you were just going to put money as savings into your TFSA account. First, you're not even going to be gaining any interest if you put it as just savings, except you maybe signed up on a particular platform where they had a promo. Generally, there are no interest or earnings made when you just put your money in the TFSA account as savings. The second piece is that it also takes up room that you should use to invest and make money. We all know that the TFSA has a contribution limit, and if you use it to save alone, it takes up the room of your contribution limits, right? So let me give you an example. Let's say you have 5,000 Canadian dollars in your savings, right? You're just putting in there just as cash into your TFSA. Later, you'll be able to withdraw the TFSA tax-free, but wouldn't it be better to instead put the 5,000 Canadian dollars in there, invest that money, make a profit, have your money grow, and let's say to 10,000 Canadian dollars, you can withdraw that gain without paying taxes, or even invest that higher amount into the tax-free savings account again. That makes more sense. That is why I always advise that it is best to keep your savings, specifically your emergency funds, in a high interest savings account. It generates some income, and while you do pay taxes on high interest savings account, it allows you to maintain more room for your investment within your TFSA. So why is having a tax-free account so important and useful? It's because it's the best way to maximize your investments and the earnings from them, okay? There are a few ways that you can achieve this through different types of investments. The first category is interest earned, which can accumulate by saving your money or putting it into GICs and bonds. The second category is dividends, right? So, which you can earn by investing into certain stock or ETF. When a company performs well and makes good profit, it sometimes distributes a portion of that profit back to its investors as dividends. So that's what I mean by dividends. The third category is capital gains, right? Which is very significant. Capital gains occur when you make a profit by selling an investment at a higher price than what you initially paid for it, right? So when you make these investments within a TFSA, all the gains and profit that you earn are going to be tax-free, which is very fantastic. So before we dive into the intricacies of the TFSA, it's essential to understand what we mean by buying within the TFSA. The first thing that you need to grasp is that the TFSA itself is an investment account, not an investment. Don't confuse the two, okay? Let me try to paint a picture here. Imagine the TFSA as a laundry basket, all right? And the investments that you purchase are your clothes that you put into that laundry basket, okay? So at the beginning of the week, after you've done all your laundry, your basket is empty, right? So let's say that basket is a TFSA. As a week goes on and you wear more clothes, what happens? You're going to start putting those clothes into your laundry basket, right? So the way that I like to picture it is that your TFSA is your laundry basket and your clothes are different investments. So as the week progresses or as your knowledge progresses, right? And now you want to start buying different investments. As that happens, you start adding those investments into your laundry basket, right? So let's say into the TFSA. That's what you need to understand and take away from this example. TFSA holds the investments. That's what it does basically. So if you leave your money in there as cash, it's just going to sit in there. So, but if you buy investments, it would also shelter your investments. Now, the investments that you can buy within your TFSA include individual stocks, bonds, and different funds, right? There are also mutual funds, ETFs, index funds, you name it. There's just a lot that you can buy within your TFSA. I think the next question you might be asking yourself after learning all of this is, how do I open a TFSA account? How do I use it? For the first question, you need to start by figuring out which platform you want to use. There are two main routes in opening the TFSA. You have the traditional route, which involves going to your bank, and then the non-traditional route, which involves using an online brokerage. Ideally, you could do both, but for the traditional route, you can go to your bank or visit their website to open an account. For the online brokerage route, you will need to choose a low-fee online brokerage platform and open an account there. Either way, you must specify that you want to open a TFSA account. That once you do that, you're on your way to starting up your investment. The next step is to figure out what investments you want to buy and purchase them within that account. Okay. Now that we've covered the basics, it might sound pretty simple, and it can be, right? But there are some rules that you need to be aware of. One important rule is that the TFSA, I think I have mentioned it earlier, has a contribution limit. That means that there are maximum amount of money you can contribute to that account before it says no more clothes can fit into this basket. The reason for this limit is to prevent people from using this account solely to avoid paying taxes on all their investment income. Okay, the government still wants to collect taxes on some of the income earned from investment, so they set up a cap. That's why you have that limit. As long as you're 18, a resident of Canada, and you have a valid social insurance number, you can start using your TFSA. Your contribution room starts building up as soon as you turn 18. Each year, the Canadian government decides on a specific amount of they want to add to your contribution room. Some years it has been 5,000 Canadian dollars. Other years it has been 5,500. Once it was 10,000, I think, and then most recently it has been 6,000 Canadian dollars per year. So what it usually would do is they announce the next year's contribution room at the beginning of the year. All right. It is important to note that your contribution room is cumulative, right? So if you don't use the 6,000 of the contribution room this year, it doesn't disappear. It adds to your total amount of room, and then it builds up from age 18 onward. Okay. So let's break it down with some examples to illustrate the cumulative contribution room. Since the TFSA started in 2009, if you, let's say, turned 18 in 2009 or earlier, meaning that you were born, let's say, 1991 or earlier, you have the maximum amount of the contribution room that anyone can have, right? So if you're a resident of Canada, your TFSA contribution from that point will be about 21,500. But if you're an immigrant like we are, they also have a way that they calculate that from the time that you land. And I would always advise, if you are confused about your contribution room, you need to call Canada Revenue Agency to find out what your contribution room is. All right. They would always be able to provide that, or you can sign into the CRA My Account to get that information also. So basically, when you start adding money into your TFSA, you're working towards maxing it out. That's the goal, right? And then year after year, you can only add the new contribution room. So let's say you have maxed out your total contribution room that you have accumulated over the years. What going forward, you would just be contributing the amount that is the limit for that year. But if you've never invested before or used your contribution limit, that new contribution room is not relevant to you until you get to the point where you have maxed out your cumulative room. So let's get back to talking about some of the benefits of using the TFSA. Obviously, we're just focused on what it looks like when putting money into the account originally, but one of the main benefits comes when you are taking money out of the account. And that's the fact that you can withdraw your money from the TFSA at any time without paying any fees or taxes. That's a big one, guys. So let's actually take an example and compare the TFSA to a regular investment account or a non-tax advantage account. In this example, let's say that I was investing within a TFSA and Jide was investing within just a normal taxable account with no advantages. Let's say theoretically that we both invested the exact same amount of money for the exact same amount of time, and then we ended up making the exact same amount of money on our investment. Okay, when it comes to the time for us to take our money out, I'll be able to withdraw the full amount of money that I invested plus the gains and keep all of it without paying any taxes. Whereas Jide would have to withdraw it, pay taxes, and then he will have a lot less money than I would, right? So you might be asking this question: if I withdraw from my TFSA, do I lose the contribution room forever? The short answer to that question is no. There's a but there too that we would get into in a second, okay? I think the best way to analyze this is through an example. Picture it like this. At the beginning of 2024, you contribute, let's say, 50,000 Canadian dollars and invest it, right? By August 2024, that investment grows to 55,000 Canadian dollars and you decide to withdraw that money, right? You are not allowed to contribute that $55,000 in the same calendar year. However, you can recontribute either the next year or in the following years, along with any additional contribution room added by the government. So what does that mean? It means that you can recontribute the 55,000 Canadian dollars the next year, plus whatever the additional contribution room is, whether it's 5,000 or 6,000 given to you by the government. Now, let's talk about the other scenario. If you put 50,000 Canadian dollars into your TFSA and things go wrong, leading to maybe a loss, and your investment falls down to, let's say, 10,000 Canadian dollars, you cannot recontribute the original 50,000 Canadian dollars if you withdraw the 10,000. You have lost that contribution room, okay? I don't know if that makes sense. So if you sell your investment at a loss, you can only recontribute the remaining amount plus whatever additional contribution room the government provides on a yearly basis, okay? So this means that you can't put back the 50,000 Canadian dollars you initially invested. You can only put back the 10,000 which you withdrew, which was the gain that you made after the investment, plus any contribution room added by the government each year. So next year, you're not allowed to recontribute 50,000 Canadian dollars. The important thing to take away here is that you must be diligent in keeping track of your contributions, okay? Your account will technically allow you to deposit any amount when you have that TFSA account. But if you over contribute, you will face a 1% penalty on the excess amount each year until you remove it. So you must monitor your contribution room carefully to make sure that you are within the limit, okay? Another thing to take note of about the TFSA is that you are allowed to have multiple accounts, okay? It's not necessary, but you might want to have separate accounts for different types of investments, such as maybe let's say you want to invest in stocks. You can open one TFSA account and invest in stocks and open another account to invest in index funds. You could also have one account with your main bank and another with an online brokerage. That's how flexible this is. The critical point to remember is that the total contribution limit applies across all your TFSA accounts, no matter how many they are. For example, if you have a limit of 50,000 Canadian dollars and you have, let's say, two accounts, you could only have 40,000 in one and 10,000 in the other, but you cannot exceed the combined limit of 50,000, no matter how many of the TFSA accounts that you have opened. Also, one of the most important things to remember is that the income earned inside your TFSA does not affect your contribution room, okay? So the contribution room is determined solely by the amount of money that you deposit in the account, not any additional income or gains that you earned on your investments. Remember that, okay? Now, something extremely important for you to know is the protection your money has when it's in various investment accounts like the TFSA. If you haven't heard of the CDIC before, it stands for the Canada Deposit Insurance Corporation. It's a federal crown corporation established by the Parliament in 1967 in Canada, and its main purpose is to insure bank deposit up to 100,000 Canadian dollars in each eligible category at any of the member institutions such as Canadian banks and federal regulated credit unions are secured, right? So what's great about this is that you automatically receive protection if you bank with one of these member institutions. If any of those banks or federal regulated credit unions were to fail, you're covered. All right, that's what it basically means. The money that you put in those institutions are covered, and you don't really need to sign up separately. So as soon as you have those accounts open and you're sure that those banks are listed under the CDIC, your money is covered. Okay, now it's important to understand what CDIC covers, right? Generally, they cover checking accounts, they cover savings accounts, GICs, and other term deposits and foreign currency. However, they do not cover mutual funds, they do not cover stocks and bonds. They don't cover cryptocurrencies and ETFs, okay? So those are the ones that they don't cover. So CDIC provides coverage of up to 100,000 Canadian dollars in 7 different categories, one of which is the TFSA, of course, which is particularly relevant to this video. If you're using a TFSA, it's going to be covered under the CDIC. Let's revisit our laundry basket analogy to illustrate this. CDIC will cover certain items in your TFSA, that is laundry basket, but not all of them. For instance, if you have 25,000 Canadian dollars in ETF, 10,000 Canadian dollars in individual stocks, 10,000 Canadian dollars in GICs, and 5,000 in cash within your TFSA. Only the GICs and the cash will be covered by the CDIC, totaling 15,000 Canadian dollars out of your 50,000 Canadian dollars investment. This means that 20,000 of your 50,000 investment will be covered and protected by the CDIC, specifically those in eligible categories like the GICs and cash. All right, so that wraps it up for the TFSA. If you have any comments or questions, drop them in the comment section below. I've got a lot of great content coming up in a couple of weeks, so stay tuned. And if you found this video valuable, please click on the like button, subscribe to the channel, guys, and share the video. Also, hit the notification bell so that you get notified whenever we upload a new video. I also would like to ask you to click on any of this next video for another valuable topic. As always, thank you so much for watching, and see you all in my next video. Bye!